The forward rate is the price at an earlier time for a foreign currency established for a future delivery in the forward market. Like in the previous discussion about forward markets, traders who are expecting to pay or receive foreign currency at a future date may agree to set a predetermined foreign exchange rate. The difference between forward and spot exchange rates reflects expectations by investors about future exchange rate movements. Discount is the selling of a currency at a spot rate that is less than the forward rate. For instance, if the spot rate for the dollar is 45 pesos and after 60 days the forward rate is 46 pesos per US dollar, the market expects that the Philippine peso will depreciate against the dollar in the next 60 days. Because the peso is depreciated in the forward market per dollar than in the spot market, foreign exchange dealers say that the peso is selling at a discount in the 60-day forward market. Premium is the opposite, the selling of a currency at a spot rate that is more than the forward rate. If the peso was expected to appreciate in the 60-day forward market against the dollar, it would be selling at a premium. For instance, if the spot rate for the dollar is 45 pesos and after 60 days the forward rate is 43 pesos, the market expects that the Philippine peso will appreciate relative to the dollar in the next 60 days. Again, firms use the forward market to lock in future exchange rates and ensure against uncertain future currency movements. This method of setting forward rates is an insurance that reduces future exchange rate risks. This method of risk protection is also called hedging or a hedge. Inflation can affect foreign exchange. The change in prices in countries can therefore influence the rise and fall of foreign exchange rates. Take, for example, the US dollar and the Philippine peso exchange rate. If prices rise in the Philippines, this depreciates the value of the peso relative to the dollar, and consequently, the US dollar will appreciate. When purchasing foreign currency, therefore, it is crucial to determine the accurate and fair foreign exchange rate, especially when entering into forward contracts. Expecting payment in foreign currency at a future date might compromise its value, so it is important to compute for the forward exchange rate. This is the forward exchange rate formula for changes in inflation rate. Let's take this simple problem. Given that $1.40 per euro and inflation rate in the US is 10% and inflation rate in Europe is at 0%, how much will the dollar exchange rate be relative to the euro after a year? By substituting the given to the formula, we get the answer $1.54 as the forward rate of future dollar per euro exchange rate. Note that the spot rate is in the domestic currency and the home inflation rate is the domestic inflation rate. Here is another example of finding the forward rate based on changes in inflation rate. Note that the spot rate is in the domestic currency and the home inflation rate is the domestic inflation rate.